Andrew W. Lowe, Adaptive Markets, Financial Evolution at the Speed of Thought. Dive into the world of financial markets through the lens of the Adaptive Markets, Financial Evolution at the Speed of Thought. Book summary. Explore the limitations of the widely discussed efficient market hypothesis (EMH) and discover a more comprehensive approach, the adaptive market hypothesis. By understanding the influence of human nature and irrational emotions on financial systems, this summary highlights the importance of the adaptive approach in predicting financial trends and preventing crises. Get ready to learn about market fluctuations, behavioral economics, and evolution-inspired investing strategies.
EMH and Smart Investing. The efficient market hypothesis, EMH, is a widely accepted theory suggesting that the price of investment assets reflects a company's true value. This collective wisdom of investors constantly analyzing and assessing the market drives the EMH's accuracy. As it's difficult to beat the market, investors are advised to join it through long-term, low-risk index funds or mutual funds. John Bogle's creation of the first mutual fund in 1976 revolutionized the finance industry and introduced these smart investment practices. The efficient market hypothesis, EMH, is a dominant theory in the world of economics, stating that an investment asset's price accurately reflects a company's overall health, profitability, and value. While imperfect, it remains the go-to theory embraced by many investment experts and academics. The reason EMH appears to work lies in the enormous amount of financial minds tirelessly analyzing the market, with each investor assessing future business prospects and adjusting the prices of assets accordingly. This shared wisdom generates a reasonably precise representation of a company's worth. To understand how EMH plays out in the real world, consider the case of Morton Thiokol, the company responsible for the faulty part that caused the 1986 Challenger space shuttle explosion. As expected, the company's share prices dropped sharply after the tragedy, reflecting a significant setback for Morton Thiokol. Since the EMH's accuracy accounts for numerous investors' collective knowledge, it's nearly impossible to beat the market or discover insights that others have overlooked. Consequently, many financial advisors recommend joining the market through long-term index funds or mutual funds, making them a relatively safe, lower-risk option. These funds consist of a collection of stocks designed for long-term investment, taking advantage of the stock market's overall, gradual increase in value. This approach led John Bogle to establish the first mutual fund, the Vanguard Index Trust, in 1976. Today, index and mutual funds are a multi-trillion-dollar cornerstone of the finance industry, proving that smart investing strategies are still heavily influenced by the principles of EMH. Adaptive Market Hypothesis Decoded. The efficient market hypothesis, EMH, might not always explain events like the 2008 financial crisis. The adaptive market hypothesis, on the other hand, considers both rational and irrational human behavior. It views the market from an evolutionary perspective, offering insights into features like market cap-weighted indexes and the role of human emotions in shaping the economic landscape. In a world ruled by the efficient market hypothesis, EMH, financial crises like the infamous 2008 debacle shouldn't occur. However, the complex world of finance never plays out exactly as theory predicts, due to the influence of emotional and irrational human behavior. The adaptive market hypothesis addresses these unpredictable elements by combining logic with the eccentricities of human nature. Human response often plays a critical role in the market's twists and turns, even when the evidence doesn't match the rationale. In behavioral economics, for instance, a seemingly healthy company may experience a sudden drop in stock price, sparking panic among traders who fear monetary loss. This emotional response, instead of a calculated judgment, disrupts the market and contributes to radical shifts. The adaptive market hypothesis allows for these human complexities while also acknowledging the logical rules governing the market. Instead of following rigid patterns, it uses an evolutionary perspective to understand the market activity and its reasons. Take, for example, the introduction of market cap-weighted indexes by John Bogle within his Vanguard Index Trust Mutual Fund. This innovative feature reduced the amount of work portfolio managers had to perform, making the fund more cost-effective and appealing to investors. The subsequent proliferation of market cap-weighted indexes across mutual funds exemplifies the forces of competition, innovation, and natural selection in action. Furthermore, the adaptive market hypothesis also treats human traits like overconfidence and fear of losing money as intrinsic parts of our evolutionary need to survive within the economic ecosystem. By understanding the role of both rational and irrational aspects, this hypothesis shines a light on the market's unpredictable changes, offering a more holistic and accepting approach towards deciphering the financial world. The human quirks of finance. The efficient market hypothesis makes the assumption that rational investors will negate the effects of irrational ones. However, researchers Kahneman and Tversky highlight just how irrational humans can be in situations such as high-risk decision-making. Loss aversion, the tendency to focus on avoiding losses rather than pursuing gains, is one such example. In one notorious case, a trader's loss aversion led him to ultimately amass billions of dollars in losses. Probability matching, another human tendency, can result in poorer decision-making, as people incorrectly assume probabilities based on recent outcomes. Being more aware of our tendencies for irrationality can foster better decision-making and improve overall economic efficiency. The efficient market hypothesis posits that the rational behavior of investors will counteract the impact of irrational ones. But just how irrational can human beings be, particularly when faced with high-stakes financial decisions? Researchers Daniel Kahneman and Amos Tversky shed light on this subject by demonstrating that people prioritize avoiding losses over achieving gains, a phenomenon known as loss aversion. This behavior can lead to high financial inefficiencies. Consider the case of Jérôme Kerviel, a junior trader at Société Générale, who in 2008 accumulated €4.9 billion in losses as he tried to compensate for smaller losses with increasingly reckless trades. Loss aversion drove him to double down instead of cutting his losses. Additionally, humans have a tendency towards probability matching, predicting future outcomes based on observed frequencies. For instance, witnessing red come up 75% of the time on a roulette wheel might lead someone to believe they should bet on red 75% of the time. However, the smarter decision is to bet on red 100% of the time, as this matches the observed frequency and maximizes the chances of winning. By understanding the limitations of our rationality in high-risk financial situations, we can take steps towards better decision-making and overall economic efficiency. Recognizing loss aversion and probability matching as human quirks will help us reflect on our own investing behavior and work towards a more rational and informed approach to finance. The brain's risky business. Our susceptibility to reckless financial decisions traces back to our emotional brain, where neurochemicals like dopamine are responsible for the pleasure we feel when we engage in risk-taking behaviors. This can become a dangerous cycle, as we find ourselves making impulsive decisions during emotionally charged situations. In order to make better financial choices, we need to recognize this mental pattern and work towards adopting a more rational mindset in our decision-making process. When it comes to money matters, why do we often find ourselves making irrational and risky decisions? The answer lies in the connection between our decision-making process and the emotional part of our brain. Neurochemicals like dopamine are released when we engage in pleasurable activities such as sex, gambling, or drug use, which are known to drive individuals to take risks. The gambling industry capitalizes on this by designing slot machines that maintain high levels of dopamine, enticing players with near-win experiences to keep them hooked. This psychological manipulation can turn risk-taking behaviors into habit-forming addictions, leading to destructive consequences. Emotionally charged situations where dopamine is involved can further impact our decision-making abilities. In these moments, we are more likely to act impulsively, neglecting rational considerations. Take, for example, the extensive training a pilot undergoes to override their natural instincts in emergency situations. A pilot must resist the instinct to pull up on the controls during an engine failure, and instead angle the plane downward to gain speed and ensure a smooth landing. Similarly, when faced with financial decisions, our emotional state can cloud our judgment, leading us to make avoidable mistakes. Fear and panic often accompany monetary dilemmas, which can skew our rational thinking, causing errors and losses. To improve our financial decision-making, recognizing these mental patterns is crucial. We can learn from the rigorous training of pilots, who must consciously work to resist the intuitive reactions spurred by panic. In doing so, we can make more informed and calculated financial choices, free from the emotional whirlwind that our brain's chemistry creates. Evolving markets and hedge funds. The adaptive market hypothesis reveals similarities between Darwin's theory of natural selection and market behavior, emphasizing the significance of evolutionary forces in economic systems. Alfred Winslow Jones, the innovator behind hedge funds, applied this concept to markets by hedging bets and lessening risks, a practice that quickly spread across the financial landscape. Though not all hedge funds succeed, their continual emergence highlights the market's adaptability, in which an efficient economic species flourishes while weaker ones fall by the wayside. The concept of survival of the fittest in evolution can also be seen in the world of finance. The adaptive market hypothesis illustrates how economies mirror natural selection. In financial markets, the powerful players, like regulators, investors, insurance companies, and hedge funds, are always vying for survival, with the most successful being described as the richest. Hedge funds showcase this principle in action with their exciting history. Alfred Winslow Jones, a statistician and sociologist, established the first hedge fund in 1949 with an investment of $100,000. His aim was to purchase strong stocks with high growth potential, while selling short the weaker stocks. This strategy lowered investment risks, hence, the term hedge fund. In just 2 decades, Jones' pioneering hedge fund delivered yearly returns exceeding 20%, drawing attention through a Fortune magazine feature. Despite the secrecy surrounding hedge fund methodologies, their popularity skyrocketed. This rapid growth exemplifies the dynamic nature of the adaptive market. An innovative and effective species, in this case, the hedge fund, emerged and promptly began multiplying, gaining dominance over traditional investment strategies. It is important to note that not all hedge funds make accurate calls, weaker funds often vanish rapidly. However, the most thriving hedge funds consistently generate massive success, and their continued creation each year underlines the ongoing process of natural selection inherent in the marketplace. Mastering adaptive market strategy. The efficient market hypothesis suggests that stock prices will eventually reflect their true value, encouraging long-term investments and waiting for equilibrium. However, the adaptive market hypothesis offers a more dynamic approach, allowing investors to respond to changing market conditions and irrational actions of others. By adapting to these situations, investors can make informed decisions rather than solely relying on the efficient market's return to equilibrium, ultimately leading to better investment outcomes. When stock markets function efficiently, stock prices accurately represent their true value, resulting in a state of equilibrium. The efficient market hypothesis posits that prices may experience temporary fluctuations, but the market will correct itself and return to equilibrium. This is why long-term investments can make sense. Investors can ride out the fluctuations, knowing that their investments will eventually attain their worth. However, the adaptive market hypothesis offers a potentially more effective strategy. Some markets experience prolonged downturns, too long for investors to reasonably wait for equilibrium. For instance, the Japanese market crashed in 1991 and remained stagnant for 20 years, a period known as the lost decades. Passive investing becomes impractical in such scenarios. In situations where stock prices drop drastically due to irrational investor behavior, the efficient market approach would advise ignoring the downturn, believing that the price will bounce back. But sometimes, a behavioral premium emerges. The irrational actions become the prevailing mindset, leading more investors to sell and damaging the company's long-term value. Relying on the efficient market in these cases would be unwise. The solution lies in adopting a dynamic approach, being prepared to change investment strategies based on prevailing market conditions. In situations like the one described above, this means selling plummeting shares alongside other investors. By embracing the adaptive market hypothesis, investors can make more informed decisions and potentially achieve better outcomes, as opposed to relying solely on the efficient market's return to equilibrium. Adapting to financial market evolution. The 2008 financial crisis serves as an example of how rapidly changing markets can outpace investors' ability to adapt. The financial market underwent significant alterations in the 1990s, with the introduction of adjustable-rate mortgages, collateralized debt obligations, and credit default swaps. As these new investment opportunities gained traction, a housing bubble formed. When housing prices began to decline in 2006, numerous homeowners defaulted on their mortgage payments, leading to a chain reaction that severely damaged banks' investments and share values. The adaptive markets hypothesis can provide insight into understanding the events that transpired, but its potential to predict or prevent a crisis remains uncertain. The inability of financial institutions to adapt to radical changes in the market ultimately led to the 2008 financial crisis. This incapacity for adaptation resembled a great white shark stranded on land, unable to survive in an entirely different environment. For years, these institutions had followed traditional practices, leaving them unprepared for the rapid shifts in the financial market beginning in the 1990s. These market changes were primarily driven by the emergence of adjustable-rate mortgages, which prompted the creation of financial tools such as collateralized debt obligations and credit default swaps. These innovations fueled a housing bubble, with mortgage-related securities in the United States exceeding $3 trillion by 2003. Economists, largely unaware of the potential repercussions, did little to alert investors of the risks involved. The housing market reached its peak in 2006 before prices began to fall and interest rates increased. Consequently, homeowners struggled to meet mortgage payments, and many defaulted on their loans. This triggered a devastating chain reaction in which investment values and share prices plummeted, culminating in widespread panic and the collapse of the mortgage industry and the broader financial sector. Applying the adaptive markets hypothesis to these events can offer valuable perspective and understanding. However, it remains uncertain whether this theory could have predicted or prevented the 2008 financial crisis in its early stages. Building reliable, compassionate markets. The adaptive market hypothesis reveals how robust legislation can help maintain stability in financial systems and promote ethical decisions. Establishing an independent financial watchdog, like the National Transportation Safety Board, NTSB, for the aviation industry, could prevent future crises. The financial sector can employ its influence to benefit humanity, such as investing in high-risk fields like biomedicine to find cures for critical diseases, following a model that diversifies risk and promises good returns. The 2008 financial crisis revealed the need for better legislation to prevent greed and fear-driven choices from devastating our economy. Just as improvements in the aviation industry were enacted after the crash of U.S. Air Flight 405 in 1992, robust rules are required to keep our financial systems in check. The National Transportation Safety Board, NTSB, an independent organization in the aviation sector, was highly effective in determining systemic flaws and pushing for reform. Similarly, a financial counterpart to the NTSB could investigate, analyze, and propose better regulations to avoid future financial catastrophes. Instead of being associated with greed and plunder, the financial industry should harness its power for the greater good of humanity. For instance, the field of biomedicine could substantially benefit from increased private investments, despite being considered high risk. By increasing attention and funds in this field, we might accomplish milestones, such as curing cancer, within our lifetime. A potential solution is the establishment of a Cancer Cures Fund, overseen by a team of experts in biomedicine and healthcare investment. This fund could sponsor 150 independent research projects financed by public investors through bonds, following an example set during World War II. These ventures should be diversified to minimize risk and maximize the likelihood of beneficial returns. With 150 varied projects, we can anticipate a 98% probability of at least 3 successful outcomes. Adopting this investment model could usher in unprecedented advances for humanity, extending far beyond cancer research. By creating reliable, altruistic markets, we can shape a brighter future for all.
In conclusion, the book, Adaptive Markets, Financial Evolution at the Speed of Thought, offers valuable insights into the shortcomings of the efficient market hypothesis and introduces the more holistic, adaptive market hypothesis that accounts for human emotions and irrational behavior. The book illustrates the significance of a dynamic investment approach that adapts to changing market conditions, as well as lessons from historical financial crises. Ultimately, the book proposes the idea that the financial industry can use its power for the benefit of humanity, such as investing in essential fields like biomedicine or environmental sustainability, by leveraging insights from the adaptive market hypothesis and utilizing innovative investment models.